Hello and welcome to interest.co.nz. I'm Janae Tibshirani and today I'm joined by the Commission for Financial Capabilities Retirement Village Manager, Troy Churton. Welcome, Troy.
Hi, Janae.
Troy, today we're talking retirement villages. Why is this something that we need to have more of a discussion about in New Zealand?
Well, about 12.5% of the 75-plus-year-old demographic have currently chosen retirement village living as their retirement accommodation. And if you extrapolate the ageing population numbers along a fixed 12.5% line, that number of residents in villages is going to double. So we want the market to be more aware of what's happening in the industry. But also, the Retirement Villages Act has been enforced now since around 2007, so it's seen a decade of positive property growth. Operators have worked hard to develop occupation right agreement propositions to that market that meet the needs of the older folk and have addressed some of the issues in the industry through those documents over time. And arguably, when you look about how the shape of New Zealand will be in 20 years' time, operators, I think, are aware they're going to need to innovate what they're offering. And maybe there's a chance for a wider public discussion about that at some stage in the future too.
All right, and I mean the Commission's doing a lot of work to start sort of getting that conversation going.
Yeah, look, we do a number of public seminar events. We have an annual stakeholder forum. We do annual monitoring reports. So last year we looked at the effectiveness of legal advice in the system, for example, because New Zealand, to its credit, is one of the few that has a mandatory requirement for legal advice before anybody can sign up and become a retirement village resident. And that's not the case in Australia, for example, where there have been some instances of businesses going bust and old folk potentially ending up in the street. That just wouldn't happen in New Zealand, I don't think. But so there are issues like that which we look at through monitoring reports. We're currently looking at the role of the statutory supervisor in the industry. And underlying monitoring reports is the mandate of one of the mandates of the Retirement Commissioner under the Retirement Villages Act is to report on issues to the Minister and to generally see that the Act and the regs are meeting their purposes, are operating effectively and efficiently.
Okay, sure. Yeah. Well, Troy, I won't put you on the spot now to run through, what we think could be changed in the law, but it would be good to just talk about what people need to consider if they or even their parents or family members are considering moving into retirement village.
Sure.
So from the get-go, what should people be looking out for, and what type of contracts are really in this market?
Yep, the occupation right agreement is the type of contract that anybody would enter into with an operator, and the dominant type of offering under that agreement is a license to occupy, and it's becoming rarer and rarer for somebody to find an actual unit where they'd buy the unit title of that unit. So the license to occupy space basically in the village and the use of facilities is very much the dominant model. But the other overlay, which is important, is that a lot of people, when they're considering an occupation right agreement, are doing so with a strong emotional situation in their lives. They're older, they're considering freeing up equity from perhaps a long-held home, and it's unlikely that many older people have a complete grasp of all the financial implications. So making sure that they're working with a lawyer who knows his or her retirement village industry well is important. And another thing we try and encourage people to do, regardless really of how much equity they have, is to discuss their decision not just with family but potentially with a financial advisor at the time that they're entering, to make sure that retirement villages are right for them, because retirement villages won't be right for everybody.
Yes, and this is the thing, it's not an investment, is it?
No. Yeah. So operators are quite transparent about that, and the whole regime is very disclosure-led, so that it's arguably very hard for a resident to go in and then say, we didn't understand, because they also have the mandatory legal advice. But the regime is disclosure-led, and it's very clear, and most people now understand, I think, thanks to the extra work we've been putting in this area as well, that there will be no share of capital gain, if any, in a unit for most residents. There are one or two villages that do offer some share in capital gain, but they're becoming fewer, I think.
Are they the smaller ones?
The ones that I am aware of off the top of my head are smaller trust types of village, yes. And understanding the types of fee model that are used by the village, because if there's one thing that retirees who are prepared to go into a village are concerned about, it's how their discretionary income might be affected should something change in the village. Yeah.
Yes.
That's a really important one.
Yeah, so actually if you've decided you'd like to move into a village, you're in there, then what rights do you have in terms of if the provider puts fees up, say 5%, and inflation is much lower than that?
Yeah, so more and more operators have foreseen this as a concern and are offering weekly fees on a fixed fee basis, but there will be still some villages out there who are a full cost recovery type of operation, and at the annual general meeting of each year, the operator and the statutory supervisor, which is an important independent role that all registered retirement villages must have. Some are exempt from having it, but it's like an additional independent professional watchdog that checks that the village is operating lawfully and that the village is operating solvently and prudently so that the residents' financial interests are protected.
But they appoint that?
The operator appoints that and is required to at the time of registration, but that, there is actually no inherent prejudice in there technically, because the supervisors also need to account to the FMA, and they also are statutorily required to report to the registrar of retirement villages on if they have certain types of concerns. So professionally they have very high standards of care to fulfil their role.
Right.
But look, going back to the original point, if a person was in a village which had a full cost recovery type of model, the operator would consult with residents about that, because anything which has the potential material effect on an occupation right agreement has to go through a process of consultation. It doesn't mean that unhappy residents can veto what the operator wants. In the situations I've seen where there has been some contention about how much the fees should go up or not, the supervisor would usually be involved in the discussion representing the interests of residents, and some sort of happy medium would be worked out. But bottom line is, if you're looking at a village which has a cost recovery model in the weekly fees, then you also obviously have a risk ratio that you are happy with to tolerate a 2 or 3 or whatever % increase per annum over the time that you're there, which comes back to, getting good financial advice at the time of entry, not just good legal advice, is a discretion that we want people to take.
Okay. Yeah. Look, and Troy, when it comes to moving out, a number of issues at this point as well. So, firstly, you're not getting your capital gain. What about if in possibly a rare situation there might be a capital loss? What happens then?
So most people understand they're not going to have a share of capital gain, and most people from our surveys understand quite clearly that the operator retains between 20 or 30% of the original capital that the resident paid to go into the village, as called a deferred management fee. But there are some occupational right agreements that operators use out there which have a clause which says that if there is a capital loss in the value of the unit, that the resident could be asked to contribute towards that loss. The anecdote is that more and more operators are leaving that clause out of their occupational right agreements, or that they would be unlikely to exercise that power if they did have it. But it is only anecdote. I know the Retirement Village Association did a survey of some of its members last year, and the results about who has it and who would use it were quite mixed.
Okay.
Yeah, but it's something to be wary of, and obviously, again, because the system is disclosure-led, with mandatory legal advice, a good lawyer would pick up on this. And we, with the education that we provide, we're encouraging people to, if this is an issue, raise it, look out for it. And if you don't want to go into that sort of proposition, don't do it.
Yes, and this is the thing as well with a lot of these agreements. There's not much room for you to request to add different terms or different clauses to these contracts.
No, look, again, anecdotally, because I don't represent operators, but I certainly liaise with a lot of them and the lawyers who represent them, and see their monitoring report showed that there are around 30% of lawyers who will go into bat and try and negotiate certain terms with operators. But what you tend to find with operators, particularly those who have more than one village, is that they want to try and get consistency with their terms, and they're unlikely to change the substantive terms of the contract just because one person isn't quite happy with, say, the 20% deferred management fee. It just won't happen. So it's more likely that if over time a sort of a collective issue, such as should we continue to charge weekly fees on a resident once they've terminated their licence, that sort of term and how an operator deals with that might change over time as a policy type of decision rather than as a negotiated outcome between a lawyer and one resident. And there has been actually a recent example by one of the corporate providers, and I'm just learning more about it currently, where they have amended their offering so that now they discontinue charging weekly fees at the same time that the resident vacates the licence at the end of the licence.
Sure. Yeah. Okay. Well, that's an interesting point to leave it, actually, Troy, because as you've said, we've seen since the new legislation has come in, we've had a cycle which has largely seen property sort of go on the up. Yep. We haven't seen it go the other way. So I guess it is a pertinent time for a bit more discussion as a country and at a policy level, private sector on this issue.
Well, yeah, look, it's yes, it could. There are certainly active lobbying residents out there, and the Commission receives a number of their referrals. And overall, however, the strong indications we get is that most residents are happy with the offering that they've entered into. The number of complaints that we've started gathering data on is still, relative to the size of the industry, quite small. There's high consumer satisfaction reported to us from the Retirement Villages Association. So on the surface of it, it's a very well-performing industry, and other jurisdictions from around the world are looking at what New Zealand's doing and saying, well, this is quite good. However, I think there are always some issues which are discrete, that we need to, in fact, I think it's the responsibility of agencies like my own that we keep an eye on, is the regime future fit, as well as being okay now, given that there are some clear trends in population growth and needs, especially to do with care coming up. And look, when I attend the Retirement Village Association conference each year, certainly it's clear to me that operators are very aware of the need to innovate and not to fall too heavily on the laurels of the current sort of profitable arrangements that they've got. Yeah.
Okay, well that's good to know. And look, thank you so much. This is an interesting discussion.
Yeah, we could go on.
we'll cut it there another day. But thanks for coming in. And thanks. Look, I mean, for people listening to this, your website, the Commission for Financial Capability, has a lot of fantastic resources. I've spent a bit of time reading some of the brochures, and they're great. So if anyone wants more information, check it out. And I'm Janae Tibshirani from interest.co.nz.